Curious about options trading but don't know where to start? Discover how calls and puts can transform your trading strategy. Whether you're looking to speculate, hedge, or generate income, understanding the intricacies of these financial contracts is crucial. Stay with us as we unravel the complexities of options trading. Welcome to our channel. Today we're delving into the fascinating world of options trading, focusing on two fundamental contracts: call options and put options. These versatile instruments offer traders unique opportunities to speculate on market movements, hedge their portfolios, or create additional income streams. By mastering calls and puts, you can enhance your investment strategy and better manage market risks. We'll break down key concepts, provide practical examples, and discuss the associated risks and rewards. Let's get started. In this video, you'll gain a clear understanding of call and put options, their respective payoffs, and strategic uses. We'll explain how buying and selling these options can lead to different outcomes depending on market conditions. You'll also learn about the unique risks and opportunities that come with each option type, including the concepts of leverage, time decay, and premium collection. By the end of this guide, you'll be equipped with the knowledge to incorporate options into your trading arsenal effectively. Options trading is a fascinating arena where investors and traders can use leverage to speculate on market directions, hedge portfolios, or generate income. The cornerstone of options trading is understanding the two basic types of contracts, calls and puts. Each offers unique opportunities and risks depending on the market outlook and the trader's objectives. While call options grant the right to buy a stock at a certain strike price before the expiration, put options provide the right to sell. Despite their distinct functions, both require the buyer to pay a premium, which represents the option's cost. Sellers in turn collect this premium, but they also take on the obligation should the buyer choose to exercise the option. Visualizing the risk and reward aspects of options can be clarified through payoff diagrams. When buying a call, the downside is limited to the premium paid, but the potential upside is practically unlimited, as the stock price can theoretically rise indefinitely. Conversely, buying a put limits the downside risk to the premium, while the potential gain maxes out if the stock drops to zero. Selling options flips the paradigm. Sellers of calls enjoy a limited profit equivalent to the premium, but face unlimited loss potential should the stock price rise substantially. Selling puts, meanwhile, offers limited gain with the premium collected, but can lead to substantial losses if the stock plummets. Let's delve into an example to grasp these concepts further. If stock Z is trading at $100, purchasing a call option with a $105 strike and a $4 premium becomes profitable if the stock price climbs above $109, while you would incur a $400 loss if it remains below $105. Conversely, buying a put with a $95 strike and a $3 premium pays off handsomely if the stock falls to $85, yielding a $700 profit, but you'd lose the $300 premium if the stock doesn't drop below $95. For sellers, the stakes are different. Selling a call at a $105 strike generates $400 profit if the stock stays below this threshold, but a devastating loss of $600 ensues if the stock rockets to $115. In a similar vein, selling a put at a 95 strike looks profitable with the stock price above this mark, reaping a $300 profit, but risks a $700 loss should the stock dive to $85. Knowing when to use calls versus puts can significantly impact an investment strategy. Call options are ideal if you predict a rise in stock prices, while puts are advantageous when expecting a downturn. Selling covered calls can be a strategy for income generation, collecting premiums while potentially capping profits as part of a bullish outlook. In contrast, selling puts can not only generate income, but also allow purchasing stocks at a desired discount. In terms of risk management, buying calls can ensure participation in a rally, and owning puts can act as insurance against falling prices. While options present unique opportunities like leveraging for better returns and hedging against market fluctuations, they also come with inherent risks. The biggest risk for buyers is the loss of the entire premium if the market does not move favorably. For sellers, the risks are pronounced, ranging from large to unlimited losses if the market dramatically shifts against their position. An additional risk is time decay, which inevitably erodes the option's value as the expiration date approaches. Therefore, comprehending the strategic use of options is crucial, not just as a tool for speculation, but also for successfully managing financial risk while aligning to one's financial goals. Let's recap the key takeaways from our exploration of options trading. Call options give you the right to buy, while put options allow you to sell at a specified price. Buyers face limited risks but can enjoy significant gain potential, whereas sellers collect premiums but take on substantial obligations. Understanding these dynamics allows you to use options strategically, not merely to speculate, but also to hedge risks and align with your financial goals. Remember, the real power of options lies in their strategic application. Now that you've learned the fundamentals of calls and puts, how will you incorporate them into your trading strategy? Will you use options to speculate on market movements, hedge your portfolio, or generate additional income? Share your thoughts and strategies in the comments below. And don't forget to like, subscribe, and ring the bell for more insightful content on trading and investing. Let's continue this journey together.